Hi, this is Prashil coming to you from Mumbai, and you're listening to the Equity Master Stock Market Wrap Up. In today's edition, I'll be taking you through what moved the markets over the week. So let's jump right in. We'll be taking a look at the latest victim of the liquidity crisis, DHFL. The RBI cuts rates to 9-year low levels. India's GDP loses its fastest growing economy tag. Now a quick look at the broader markets. Global markets were positive amid expectations of a rate cut in the US. Back home, Indian indices were volatile on the back of a rate cut by the RBI. With the markets out of the way, let's look at the key stories that were in focus this week. The Monetary Policy Committee of the RBI announced a 25 basis point rate cut in its second bimonthly policy review in 2019. After the cut, the repo rate now stands at 5.75%, the lowest since July 2010. Apart from the rate cut, the MPC also changed its policy stance to accommodative from neutral. This marks the third rate cut in a row by the central bank, and the move was largely in line with market expectations. The RBI press statement said that all 6 members of the MPC voted in favor of a 25 basis point rate cut in this meet. In its statement, the MPC noted that the growth impulses have weakened significantly, as reflected in a further widening of the output gap compared to the April policy meeting. It, however, stated that there is scope to accommodate growth concerns by supporting efforts to boost aggregate demand, in particular, reinvigorate private investment activity, while of course keeping the inflation target in mind. The MPC also revised its GDP growth rate estimates for FY20 downward to 7% from 7.2% in the April policy. In FY19, GDP growth stood at 6.8%, which was lowest in 5 years. Market participants and economists see a rate cut crucial at this point, as the economy has been witnessing signs of slowdown. India's retail inflation has remained benign for some time now. It stood at 2.9% in April, which is well below the RBI's mandated target of 4%. Slowdown was also witnessed in the domestic economy in the sub 6% GDP growth for the March quarter. In its April review, the MPC had emphasized the need to shift focus to growth after having achieved price stability. What measures the RBI takes ahead and how this pans out remains to be seen. Now, the rate cut by the RBI means a drop in the cost of funds for individual and corporate borrowers. However, banks have not been very efficient in passing on the benefits of the recent rate cuts to their customers. Excluding the latest rate cut, the RBI has cut policy rate by 50 basis points so far in 2019. However, banks have not adjusted their lending or deposit rates accordingly. On the contrary, a number of banks have raised their deposit rates to mobilize funds. While banks are struggling with high NPAs, NBFCs are struggling with solvency issues, leading to a credit freeze. DHFL was in focus over the week, as many rating agencies downgraded the commercial papers issued by the debt-laden company to default. The company missed its interest payment deadline on a set of outstanding bonds. But the embattled company is in talks with financiers to help meet its 1,000 crore rupees plus obligation within the 7-day grace period and prevent a default. In response, DHFL said that the action taken by the rating agencies was extremely surprising, as the company has been making and continues to make substantial efforts ensuring that the company has no defaults on any kind of its bonds and that it continues paying off all of its financial obligations. Since September 2018, the company has repaid close to 400 billion rupees of obligations and also sold its strategic retail assets, including Aadhar, Avance, and DHFL Pramerica asset managers. Meanwhile, reports also stated that the company will meet an SBI-led consortium in the coming week and might opt to selling part of its portfolio to banks for 15 billion rupees. Note that DHFL is also facing questions about its financial health after the IL&FS default pushed up the cost of funds for the mortgage lender and has made borrowing much more difficult. Moving on to news about the economy, India's gross domestic product grew 5.8% in the January-March quarter, confirming fears of a slowdown as the new government assumed office. With this, India lost its fastest growing economy tag to China again. Real or inflation adjusted GDP grew 6.8% in FY19, lower than the previous year's 7.2%. The growth in GDP was slowest since FY15. Slowdown signs have been visible since last year, with GDP growing 6.6% in the October-December quarter of 2018. The national income data has reinforced deceleration signs that were emanating from a slew of shop-end data, such as car and consumer goods sales, often seen as proxy indicators to gauge trends in household spending. Fourth quarter corporate results have also shown a significant slowdown in profit growth across sectors. People are buying fewer cars, and domestic sales, production and export of automobiles reflected in this deceleration. Similarly, growth in FMCG goods has also slowed down considerably in recent quarters, mirrored in slowing sales of consumer staples such as biscuits, soaps, oil. One of the first tasks of the new government will be to usher in policies to boost people's spending and buoy demand. This, in turn, will prompt companies to invest more, add capacities to meet growing demand, and eventually hire more people. The new government will present its first central budget in the first fortnight of July 2019, amid heightened expectations that it will offer tax breaks to individuals and households, giving them more money to spend and save. The new government has to quickly move on to policies to raise farm incomes and also ensuring that retail inflation remains within the central bank's tolerable limit of 4%. Well, that's all from us today. Before signing off, we would like to know if you like our podcast. Is there anything specific you'd like us to cover? We would love your feedback. Just visit equitymaster.com and drop us a line. We look forward to hearing from you. Thank you and happy investing.